It's a great passion of mine is generation wealth planning and looking at areas where we can help families in terms of IHT strategies and so forth. The key point is it's a tax. When is it payable? On death and on certain gifts that we make during our actual lifetime. How can we actually look at legitimate ways allowed by HMRC to reduce the value of the estate? The first one is the transfer between spouses and indeed civil partners. Transferable nil rate band. Husband and wives, when one passed away, the nil rate band that belonged to the husband or the wife actually can now transfer across to the survivor so that the full nil rate band of the first to die is actually claimed on the second death. That change actually removed quite a number of estates from the potential of inheritance tax. What are potential exempt transfers? These are gifts that one makes whilst we are alive. There's no actual tax when one makes that payment. And if one survives 7 years from making the payment, the actual transfer of value is then out of one's estate. Chargeable lifetime transfers. These are basically lifetime gifts, like the pet, potential exempt transfer, where one needs to survive 7 years. But the difference with those particular transfer of values is that these are gifts into a discretionary trust. So why bother having a trust? That's the key question. The key motivation is to control family assets. I would call it bloodline protection. I would call it generation wealth planning to ensure that the family money stays within the family. A discounted gift scheme. But why would anyone actually buy this particular solution? What is the benefit? That is a key question. First of all, there's an immediate reduction in IHT on part of the premium that has actually been invested into the solution. The balance falls out of the estate over a 7-year period. So we go back to this clock ticking and the magic number 7. And all of the growth is outside the estate. But crucially, the investor, the settlor, the client, they have the legal right to income, broadly about 5% for the remainder of their lifetime. Another solution in terms of trust planning is grandparent and grandchild trust. The grandparents invest the money into a discretionary trust, but we combine it with a bare trust for tax benefit purposes. Because when school fees become due, the trustees, which would be probably the grandparents plus the parents, they could then decide to appoint chunks, I'm going to call it chunks, from the trust into what we would call a bare trust in the name of the trustees for the benefit of the child. But the key point is the tax is then on the child. And obviously all children have obviously got their own personal allowance, about £10,000. So that can then be a bona fide way of actually providing for school fee planning. The key point is that the monies that go into the discretionary trust in the first place would be a chargeable lifetime transfer from the grandparents. So that is a device to reduce the grandparents' estate for IHT purposes.